What is going on, investors? Back again with another stock analysis. This time we're taking a look at Beyond Meat, ticker symbol BYND. Now, this stock went public not too long ago. This chart doesn't go all the way back, but they went public just before this, about 60 some odd dollars a share. This stock rallied major hard all the way up into the $230 range, only to crash all the way back down close to the IPO price and then rally again and then crash again and then rally again. I tell you what, you call this a roller coaster ride. If you can handle this type of roller coaster ride of a stock, then maybe this video will be for you. So before we get into whether we're going to be buy, sell, or holding Beyond Meat, let's first jump into the financials. First thing I want to do is take a look at a year-over-year view, kind of the revenues and the profits, if there are any, and see where we're at with this stock. We notice this stock is still, it feels like it's still in its early stages. Companies like Uber and Facebook, they become public and they're already rather mature. This company is still, I feel like, really growing. And so that's an intriguing part of this investment. So 2016, not much revenue, but they did a really nice job doubling it in 2017. Then they nearly tripled it in 18. And then, oh my gosh, I don't know if I can do the math. That is almost a quadruple, I guess, all the way into 2019. That is what we call explosive growth. And I think investors are kind of counting, at least on when the stock trends up, counting on this number again accelerating. We take a look at cost of goods sold, and in some cases this is not a major high margin business. Notice here back in 2017 they actually lost money just based on cost of goods sold. Okay, we haven't gotten into any other expenses. Before even getting to other expenses, they lost money. We see here on $88 million in revenue, they've only made 17 million. I say only, that's still pretty darn good, but I think in the food service business, you're not going to see those like tech-like margins where you're getting 50, 60, 70%, although the margins ticked up kind of nicely, it feels like here. So maybe that's the trend that they're working on. They're still scaling up the business, scaling up some of the processes in terms of trying to develop this product. Now, we see research and development has ticked up as well, along with the revenues. The selling in general and administrative. Obviously, when you become public, like between this time frame, you're going to see a natural acceleration. It'll be interesting to see during 2020, will this expense in particular start to level out. We've got some restructuring expenses here. Those look to be very, very low in terms of what we're dealing with here. Now, let's take a look at the most recent year, full year at least, and we see here that the company just wasn't profitable. So just barely not profitable. So again, investors are going to be expecting this top line to grow, probably not really worried about profits. Obviously, this is a company that's never turned a profit. And, there's been plenty of times this stock has rallied hard. And it's not based on these profits. I get questions all the time. Am I looking at PE ratio? Am I worried about earnings? With these younger companies, I'm not. With these companies that are still trying to grab market share, still trying to accelerate this top line, no, I'd rather them actually take any kind of profit they have and reinvest it in research and development, reinvest it in the product, in trying to make it better and capture market share, whether it's marketing or the product itself, packaging, any type of thing. I'd rather them actually not make money. So I'd rather them take the money that they would show here on paper, and it might make you happy as an investor to see a profit here, but in the long run, it'd probably be better for this company to reinvest the money, and that seems what they're doing. Although this is, well, look at these losses. They're actually very much under control. They're almost flat, and now they turn positive. So that's, that's probably a positive. The other thing I want to point out to you is take a look at these are the weighted shares outstanding right here. And notice when you went public, you went from 6 million shares to 42 million shares. I have a feeling this number will continue to get bigger because this company will probably need to raise some cash going forward. And they have cash here. They have 275 in cash and 355 in working capital. But I think a company like this is probably going to need to keep accelerating the cash flows and things like that. And so you might see further dilution. Along with stock-based compensation, this company will be rewarding its employees with stock. So now, let's take a look at the most recent quarter. So we saw, the reason why I showed you year over year is we're seeing explosive growth. That gets you excited as an investor. What I want to take a look at here is we have the most recent quarter. This is the most recent quarter ended March 28, 2020. They're giving you a year over year view. So this is back in 2019. And obviously this still looks like explosive growth. It is explosive growth. We've got gross margins basically tripling. We had revenues not quite, like a little over a double, and gross profit tripled. So that's good. It's showing you that these cost of goods sold, as this company is scaling up these revenues, these cost of goods sold is actually scaling down a little bit, which is a great sign. So margins are going up even as sales are going up. So that's good. You really like to see that as an investor. We're seeing this research and development stay well within line. Selling and general administrative for the whole year back here was 74. So if you annualize this out, they're on pace to grow that actually quite a bit. This would be well over 100 million times 4, which is, 4 quarters. So that's not great. We have, again, some more restructuring expenses here, but it's somewhat inconsequential to the bottom line or even the top line. So total operating expenses are here. We're going to come down. Let's just come all the way down to net income here. So look at this most recent quarter. Last year at this time, they lost 6.6 million. This quarter, they actually churned out a profit of $1.8 million. And notice we have weighted outstanding shares here, 61 million. I just showed you at the end of 2019, they had 42 million. So that dilution is still coming. And so that's something that you definitely want to think about as an investor. But now, here's my main point with Beyond Meat. We just saw they had explosive growth year over year here on a quarterly basis. They've had explosive growth year over year here on this top line. But I want to show you something that's maybe a little concerning to me. Doesn't make me super excited. So here's that March quarter we just saw here on. So we had 40 million in revenues here. Here it is right here. And they break it out with retail, food service. This is the US and this is international, and they break it out here. So we're seeing a quarter over quarter over quarter over quarter view. March, April, May, June, and then so on. So this was just 3 months prior to this. I hope that makes sense. So this is a year over year view, but I just want to flash forward 3 months ago. Okay. Like, I get that this company is growing year over year. How are they growing quarter to quarter? Because I really think with these high growth companies, you don't necessarily have to do this with a Nike or a Facebook or something like that. Year over year is probably how you want to go. But these high growth companies, are they continuing that growth? Now let's take a look here. So this is September quarter. They had, here we are, net revenues here. They were at 91 million, call it 92 million. Okay, 3 months later, it increased a little bit here up to 98 million. Now, here's the key thing. 3 months later, they're at 97 million. So the growth actually went down. So we see 91 million, 98 million, and now we're at 97. So for me, I'm actually starting to see a flat line of revenue. Now, I know this company claims that their peak seasons like barbecue season and stuff like that. And I buy that maybe to a certain extent, but people eat burgers and people eat this product year round. People don't just eat meat in the summertime when you can barbecue. So this is probably the most concerning thing to me about Beyond Meat is as a quarter over quarter over quarter basis, revenues are essentially flat, and they're actually down about $1 million on a quarter basis. So that doesn't really honestly make me super excited as an investor, especially when you're talking about a stock that is on a straight up Six Flags roller coaster ride. So How do we play this? Okay, buy, sell, or hold Beyond Meat. I think with the way this stock chart trades, it is very, very difficult to pick a price and feel good about it. Like, oh, I bought in at 70, I feel great about that. Well, sure, yeah, when it ticks back up to 110, you do, but then it dips all the way back down to 60 a few months later. So if you can survive this type of roller coaster, by all means, I wouldn't balance my entire portfolio around this. But if you've got, let's say you have a $10,000 investment portfolio and you want to throw a couple $100 at this stock, I don't have any problem with that, especially if you're a younger, 25 to 35 type person, which is probably the bulk of people watching this. I don't got a problem with that. But I think there might be some better ways to get exposure to Beyond Meat without getting exposure to this really crazy rocket ride. So first thing you can do is you can find ETFs that have Beyond Meat in them. And so I just did a search, and it took me to ETF.com. I'm not affiliated with this site or anything like that. There might be other sites that are even better. But here's ETFs with the most Beyond Meat exposure. And this ETF IPO, I took a look. So they have 3% of their allocation is in Beyond Meat. So you're actually getting a pretty hefty pretty hefty exposure to Beyond Meat from an ETF. You notice all these other ones are less than, call it a 1.5% or a 1.75%. So you're not getting Beyond Meat rallies really hard. You're not going to feel it too much in this ETF. Now, the thing with this IPO ticker symbol is they're only going to hold Beyond Meat a maximum of 2 years after the IPO, which was just back in 2019. So you probably only got about a year left where it'll be in here. And so maybe some of these other ETFs will be a better exposure if you're looking to hold it long term. Now, there's some other funds that have it, and you can kind of dig in here, but usually they're like a very small amount of funds that have exposure to Beyond Meat. So if you want to get exposure to Beyond Meat, but you don't want to buy the actual shares, I think getting some exposure via an ETF is not a bad thing. Now, if I were to buy this stock outright, I don't know where I would do it. I mean, I think there's some support here when you see the stock when it drops down close to the IPO price in that 60 to 70, maybe even call it $80 range. It does seem to catch a bid. But the thing I'm looking for is, again, I'm seeing quarter over quarter flatline. They're actually on pace. So they did 297. If that continues into the next quarter, they're really on pace for about $400 million in revenue. And we're talking about a company that is valued at close to $8 billion. So an $8 billion valuation on $400 million in revenue. And then we're talking minimal profit. That's not super attractive risk reward in my opinion. Now, on top of that, you're going to have extensive dilution with a stock like this. They're going to be rewarding shareholders and insiders with more and more shares of this company. For me, I would stay on the sidelines with Beyond Meat, again, unless you want to get exposure through some of these ETFs. Now, the interesting thing is the IPO market has gone pretty quiet. So, the exposure to Beyond Meat might stay relatively the same in that ETF. That's just kind of a side note. If you want to trade this stock, notice it went up 6% in a day. Okay, I don't mind that, but these videos don't really, talk about technical analysis and things like that. I'm more of a buyer hold investor, and just the way this stock chart is setting up, the way the quarter over quarter revenue is kind of flatlining, to me, I don't really see a compelling reason to buy and hold this stock. Now, if you want to trade it, knock yourself out. I would set very tight stops. So if you buy at a certain spot, set a tight stop underneath it. So let's say you bought here at 122 for whatever reason. Well, I would have set a stop down here maybe at $90. So when the stock broke that price, price, you sell your shares, and then maybe you enter back into it. So definitely a watch list stock. Keep this one on your watch list. It certainly is well hyped and well covered, and certainly from that perspective, it's entertaining. Hopefully you enjoyed this video. Again, if you have a stock you want me to cover here on the channel, by all means, leave me a comment below. If you're long Beyond Meat and you love what's going on here, leave me a comment and tell me why you disagree with what I might have just covered on the show. So if you like what we're doing here on the channel too, please, please, please hit that subscribe button and consider hitting that like button as well. It really helps the channel out. Really appreciate all the comments I've been getting. Appreciate you guys. Good luck with your investments. We'll see you guys soon.